overly aggressive and make completely ridiculous assumptions about the future. That's a hard business to go under. It'll never be below 100. You guys are idiots. That's just the way it works. The googly moogly. We have Google here on the video for today. Google's down a little bit. Now, one thing I want to comment on Google before we go further is, the last 2 years, go look at our past videos of Google. We sat there and said, listen, at 150 it's too expensive, at 160. And people wrote to us, it'll never be below 100. You guys are idiots. Yeah. Let's pull up Google real quick and see how it looks right now. Google is currently at 100.67 with a 52-week low of $83 back on November 2nd, just 5 months ago. Yeah. Now, not to say, aha, it's just say, guys, stocks are going to go up and down like crazy. It's going to happen.
Even ones of the caliber of Google.
Yes, and Google has a phenomenal balance sheet. This is the kind of company you want to own forever. But still, people's emotions will change on a company at some point. At all points, you know, Joel Greenblatt in his book, the little book that beats the market, he talks about it in there. He says, guys, go look at the 52-week high and low for companies. They're pretty ridiculous. There are 30, 40, 50, 60% differences in these prices. That's just the way it works. So that's the reason why watching our channel will get you ready for when those opportunities arise. When those opportunities are there in front of you, you need to be able to understand the companies so that when you see the price you want, you jump on it.
Right.
Right, Mo?
Yeah, exactly.
We look at Google, and we're going to do our analysis on Google. We're going to go through the entire process and show you at the end, based on our stock analyzer tool and our assumptions, what we're willing to pay for Google, right?
Yep, absolutely.
Let's do some high-level stuff on Google. First things first, Mo. Look at this market cap. 1.34 trillion. Look at the enterprise value.
Oh my gosh, it's almost exactly the same.
It's actually lower.
That's amazing.
So this difference means, guys, that balance sheet has a lot of cash on it and little debt.
Yep.
Because the market cap is what you'd pay to own the entire company with all the shares. The enterprise value is what you'd pay if you basically want to buy the company free and clear of all debt and net of no cash. So that's a hard business to go under when you have such a low enterprise value relative to market cap. So remember, a lot of cash here, a lot of cash, and we'll see that shortly. Now, 1 year PE, 22, 5 year PE, 27. Okay, so is that high? I don't know. Now, I will say this. I like this. The return on invested capital, 14.5%. Now, if you've watched our channel before, you know how much we love the return on invested capital. It's a very popular metric for all value investors. If you're new to the channel, what this means is, this is your basic way of showing, oh, look, somebody's messaging me. This is your way of showing people that there's a moat. The higher the return on invested capital, the bigger the moat. And that's a 500-foot view. Basically, it means they don't need to invest as much money to grow profit as other companies do. Right? The market's going to do about 10%. So at 14.5% and last year 17%, that means they get a good return on the money invested in the business. If they want to increase their profit, they just need to invest less money than a company that might have an 8, 9, 10% return on invested capital. That might sound complicated. It's okay. It is when you first hear it for the first time. In your life, there are things you do very well that other people wouldn't understand when you try to explain it to them immediately. But just hang on, watch more videos, and you'll understand this concept more and more. All right, so let's do our 8 pillars here. All right, Mo, what you got there? So Mo, what happened to your pillars?
Oh, well, I did this for a video yesterday.
So we have custom pillars here if you look at this.
I'll customize my own right now.
I keep my pillars as the ones right here because these are basically the ones I picked. But you can customize your pillars up to 12 and a combination in the trillion. So if that's appealing to you, go to everythingmoney.com, sign up, $7 for 7 days. That's $1 per day. Try out the software. I guarantee it will change the way in which you look at money. You get the entire community of thousands of like-minded investors. You get all of our tools here. And as it grows, you get all those tools. Go ahead, Mo.
Just an example of this. I'm going to put in a forward dividend of greater than 2%. Now, this is not going to hit for Google because they don't pay a dividend, but you're going to see that you could run these types of screeners, and this is where you fill out all 12 categories. You could change it if you want 12.5, 13, 14, 20, whatever you want, you could put it in there. It's really cool.
Yeah, it's awesome. So based on the original pillars, guys, here's what we got. We've got all checks except for 2. The 5-year PE of 27.5, the 5-year price to free cash flow of 30. That kind of tells it's expensive, but again, it has a high return on invested capital, and if it has amazing growth potential, you should be willing to pay more money. It's okay to pay more for a better quality thing. And that's what I want people to remember. You should pay more for better quality. That's like telling me, if you're not willing to pay more, you'd pay the same amount of money for a Ferrari as you would for a Mazda CX-3. That's a ridiculous statement. Although, did you see, you did see that, where Ferrari just came out with their new SUV and they compare it to a Mazda. They're like 3 Series SUV and it's literally the exact same thing. And it's going to be 300,000 or whatever the price is going to be.
Yes.
So from here, I'm not looking at this going, F Google. I'm just looking at going, okay, there are some things that I have to pay attention to. It's not some screaming buy, obviously, but Google has a lot of potential. So let's check out the analyst estimates. Now remember, guys, analyst estimates are to be taken with a grain of salt. They have career risk just like anybody else. They have to sit there and make people happy. Look at SVB, Silicon Valley Bank. Not a single analyst had them as a sell just right before they went under. Not a single one. Okay, that's something to be very cognizant of. Now, for this year, analysts are expecting Google to make $5.24 per share, growing to almost 10 in the next 4 or 5 years. But the number of analysts really dropped significantly that cover it going out that far. It just shows you the short-term bias that analysts have. They want to focus on right now, right here.
And they don't want to put their necks on the line going out.
And by the way, it's hard. It really is difficult to say what's the company going to do in 5 years. Mm-hmm. Now, for revenue, they're expected to do $308 billion this year and then $470 in 2024. So look, their revenue is going to go up by roughly 50%, and their profit is expected to double. And that should happen with companies with such a good gross margin. Look at their gross margin over at Google. Their gross margin is 55%. What does this mean? It means for every extra dollar they sell, they can add 55 cents of that, 55% of that to pay for their overhead and their income taxes, et cetera. When you have high gross margin, adding those extra dollars really adds to the bottom line very quickly. And that's important. And for a bottom line margin of, low and mid 20s. All right. So Mo, so far, what do you see that's like kind of like, oh my God, I hate this?
The only thing is the revenue growth in the past couple of years and profit growth in the past couple of years. And I'm going to assume cash flow growth. Let's see. Yes.
You don't like it?
I like it, but is it something that they can continue to grow from this point, or is it going to trim it back and then grow more in the future?
Okay, so
I don't know if it's normal to go from jump $100 billion in 2 years when it took them, let's see, is that revenue? Yeah. Because I'm looking at this saying, they were doing $66 billion in 2014. It took them, I'm going to call it 2019 to do 166 almost billion. And then they just did. Yeah,
but it's easier to grow from 166 to 260 than from.
But is this sustainable? I mean, we went through COVID. Everyone went to the ad side.
Exactly.
That's what I worry about.
But the world now.
Everyone went to the YouTube side, and that's obviously slowing down from its crazy peak that it was at.
Right. So my view of it is this. I'm looking at Google from a very, very long-term perspective. Mm-hmm. I'm going to look at it when we do our stock analyzer tool from a 20-year perspective. Do I think Google will be a bigger company 20 years from now than today?
Yeah, 20 years, yeah.
Guys, the world is growing. The world's becoming more wealthier and wealthier. It's going to increase the value of online ads. And Google has the top 2 search engines, Google.com and YouTube.com. They own Gmail, the number 1 free email service in this world. Mm-hmm. Right? Yeah. So I look at this thinking to myself, okay, are there issues there? Of course, there's always issues in every company. Mm-hmm. Always going to be issues. But I look at Google saying they own the digital marketing world.
I will say this. These are the only issues that I'm seeing, and those are issues that can be overcome pretty easily.
Yep. And I do think that their profit should have been higher during COVID because they had look at this growth of revenue.
Mm-hmm.
$75 billion more in revenue.
That's insane.
At a 55% margin. That's why you see a jump from $40 billion in profit to $76 billion in profit. Yeah. That's the point of gross margin, guys. If the gross margin here was like Amazon was just 12%, it's not going to jump as much as relative to the revenue. And that's the important part to understand. So let's go here and let's go to our stock analyzer tool. So guys, like I said, I'm going to do a 20-year analysis. Mo's going to do a 10-year analysis. The key here is we don't know the future, but what we can do is make assessments about the future based on companies. People tend to be overly aggressive and make completely ridiculous assumptions about the future. We like to be more conservative. We're going to do a low, middle, and high on Google. Okay. Now this part right here of our software was used 1.3 million times last year by our users. That's how important it is. The number 1 part of our site. And it's one of many tools on our site. And this one was used 1.3 million times because it allows you to determine a price to pay for the company based on your assumptions about the future and the profitability. Okay. So quick pause. We'll come back and we'll explain our assumptions. Okay, guys, so I'm doing something a little bit different here, Mo. I'm going to skip right to desired return. I'm going with 10% all across the board.
Okay.
Just to see what I think, that's essentially my intrinsic value. What do I think the company is worth, okay, based on those assumptions? And my goal is to buy at a discount. Mo put in 10, 11, and 12% because he's putting his margin of safety. And I'm going to do the same thing just to show you. All right, so I have two sheets open. They're going to show one with 10% across the board and one with my margin of safety. So Mo, revenue growth. What'd you do for 10 years?
I did 5, 8, and 11.
Okay, I did 4, 7, and 10 for 20 years. Okay. Guys, that's a big number.
It's huge.
That's essentially doubling 3 times.
That's huge.
That would take their revenue to like $1.8 trillion.
Right, because they're currently at 383.
It'd probably be higher than that, actually, because tripling 3 times is 8x. That's $2.4 trillion. People are messaging me like crazy in our community. All right, profit margin. What'd you do, Mo?
20, 23, and 26.
Okay, I did 20, 22, and 24. Yeah, 26. Okay. Now remember, these are high. Okay, free cash flow margin.
Same, 20, 23, 26.
I did 20, 22, 24.
Okay.
PE.
I did 16, 17, and 18.
I did 15, 16 and a half, and 18.
Okay.
For both PE and price of free cash flow.
16, 17, 18 for price to free cash flow, and the return 10, 11, and 12.
Now, guys, remember, for PE and price of free cash flow, I look at this going a higher potential growth rate, a higher moat, a higher return on invested capital. That's why I put 15 on the low side. If this company was a declining company, which we do very few of those, I'd have a much lower PE. Mm-hmm. Right? Now, I hit the analyze button. It's very key, guys. I want you guys to stick with me through this entire time because I'm going to show you all the values I have. This first value is based on what I think the company is worth based on intrinsic value based on these assumptions. I hit the analyze key. Okay, I have a low price of 72, a high price of 200, middle price of 120. That's based on what I think it's worth. That assumes no margin of safety if I paid 118 for it. And if I bought it today and I think it's worth 120, I have about a 15% margin of safety, okay? Now, let's go to my actual margin of safety. Boom, 10, 12, and 14% return for my assumptions. 72, low side, same because it was 10%. High side of 120, low side of 93. So if I buy this for $93 now, I'm expecting to make about 12% return if my middle category comes up. Mm-hmm. Mo, what'd you get?
I have 78 on the low end, about 150 on the high end, and maybe 110 in the middle. And it's been my buy price at about 85 for quite some time. So it kind of aligns with those numbers between low and mid.
Yeah, so I think we're sitting here, and I have it on my watch list at $85. Add it to your watch list, and I think you guys will enjoy this very much. Again, everythingmoney.com, $7, 7 days for all the software. Take care.